From Mumbai's hustle and bustle, Sivasubramanian prefers to be based out of his native Chennai. As a CIO of Franklin Equity at Franklin Templeton Asset Management, Siva feels staying away from Mumbai helps in removing clutter from investing life. His focus being spotting companies that are consistently profitable over time, something Siva has done successfully over a career spanning 2 decades. In fact, Siva stands out among peers in delivering consistent returns on his funds despite market cycles. An IIM Calcutta graduate, Siva oversees more than 13,000 crores of equity assets in schemes like Franklin Blue Chip, Franklin Prima and Franklin Prima Plus. A quiet and reserved person who enjoys reading in his leisure time, Siva is clear that the downturn is just part of a larger cycle.
I don't think it's anything new to India. We've been through these cycles in the past, and I think it's a repetition of that. Any economy would go through, ups and downs, and right now we are in a down cycle in terms of growth slowing down.
Are you worried about the rupee depreciation right now?
I think the sharp depreciation in the rupee is definitely a concern. Having said that, I think the rupee adjustment was overdue, and probably it has happened suddenly in a short period of time, but something which had to happen. It does give exporters, a leg up in terms of competitiveness, but I don't know how well, Indian companies are positioned to take advantage of the depreciation. The fact that, our imports are much more than exports means that, in rupee terms, our import bill has gone up that much more by 25% or so. Of course, to the extent that commodity prices have corrected, and almost 50% of the import basket consists of commodities like oil, coal, etc. The fall in these commodity prices to some extent negates the impact of depreciation. But having said that, I think it is too sharp, and corporate India probably is not prepared for such a sharp depreciation in such a short period of time.
How do global events influence your decision as a fund manager?
Global events influence us as fund managers to the extent that the flow of money into India can get impacted, and that can have a serious impact on performance of stock prices. But it's not going to have a big impact on the actual performance of companies. And our focus has always been to cut out the noise in terms of technical factors which impact market on a day-to-day basis, and focus more on the business aspects of a company. And if these global issues impact the stock prices, it may give us an opportunity to hold on or increase exposure to some of the better quality companies.
But doesn't the volatility kind of compel you to change or alter your conviction calls from time to time? I mean, what's the duration for which you keep your portfolio unchanged?
If you look at our flagship funds, the turnover ratio is around 50% or so in funds like Blue Chip and Prima Plus. So obviously we take much longer term calls relative to some of the peers. And so the short-term pressures really don't impact the portfolio calls. We have seen global growth slowing down. The US has slowed down quite considerably. Europe obviously is in need of another injection dose of liquidity. So all indications are that we may have another QE3 sooner rather than later, and that is likely to fuel another rally in many of the so-called risky assets.
And you see that happening, let's say, by the end of 2012, early 2013?
Well, the way global economies have weakened in recent times, it looks like it will happen sooner rather than later.
What are you doing in the market right now? I mean, what are your sectoral or stock preferences at this point?
Like I mentioned earlier, we normally don't take these top-down sectoral calls. It's more focused on individual companies and bottom-up calls. Having said that, we have been quite positive on sectors like telecom, which have not done too well in the last 2-3 years on account of regulatory issues. We have a fairly big overweight position on sectors like telecom.
Despite the controversy there?
Well, probably because of the controversy, I think the valuations have been quite low on account of these controversies, and it's given us an opportunity to build fairly big positions in these stocks.
So what's your approach to the market? Are you looking at contrarian themes like the one you just pointed out in telecom? Are you looking at value themes, or are you looking at stocks which are commanding a scarcity premium?
We are style agnostic. We have a combination of growth focused stocks, value stocks, as well as some exposure to sectors like FMCG. Having said that, right now if you look at our portfolios, we seem to be underweight on the FMCG theme. That to some extent explains our position.
Have you booked profits in FMCG and select pharma companies?
We have to some extent reduced exposure in select FMCG companies. As far as the pharma sector is concerned, we still are extremely positive. We have in fact increased exposure to the sector recently.
What about momentum sectors? What about the traditional sectors which are linked to the investment cycle, infrastructure, construction, cap goods? We've also seen a fair amount of interest come back in real estate, purely on the basis of analysts expecting that the selling has been overdone in the sector and perhaps there could be a turnaround in the offing. What would be your approach to these sectors?
I think each fund house has its strengths and weaknesses. We are not extremely strong on some of the sectors you've mentioned in terms of understanding them and investing and making money in them in the past. So we've sort of shied away from quite a few of these sectors. Having said that, we do have fairly significant exposures in the capital goods space to companies like, for example, Cummins, and these have been core holdings in some of our portfolios for a long period of time.
What have you made of the kind of controversy that's hit the cement sector right now with the CCI order?
I think it's a fairly draconian kind of an order, and cement as a sector has not been extremely profitable over the last decade or so. It's only a few years when the whole sector as such has made profits. I think the order will be tested in court, and whether there was a cartelization or something has to be proven. The order, if I understand correctly, has not provided concrete proof of cartelization, but if the order is upheld, I think it is extremely negative for the sector.
I observe that you have concentrated portfolios across your funds, with the top holdings having an average weightage of about 7 to 8%. What's the rationale behind such a portfolio strategy? Is it capital protection, or just essentially you believe that there is still growth in some marquee names?
Well, I think it's the latter more than the former. We tend to have a diversified portfolio, but having said that, we have fewer names in our portfolio compared to some of our peers. The aim is to put more money behind stocks where we have high conviction, and the upside potential is quite high.
Well, Siva, we'll talk about that and more in just a bit. Take a short break, but when we come back, we will discuss with Siva the specific fund philosophy of Franklin Templeton Asset Management. Stay tuned for that.
Opportunity comes knocking every minute on ET Now. ET Now gives you more stock ideas from the best technical analysts every day and talks to the management of the most promising companies. Breaking stories that impact your investments. Make every opportunity a profit opportunity from 8 to 10:30 a.m. only on ET Now.
Ye hai NASA's most ambitious project, Juno, the spacecraft on a 5-year mission to discover Jupiter's secrets. Juno's scientific payload includes specially designed, no cameras please, high-speed engines that will take it to Jupiter in just 1 year. Any questions?
Yes. Kitna deti hai?
For a country obsessed with mileage, Maruti Suzuki makes India's most fuel-efficient cars.
Sometimes things are more than they appear.
Wonder Nights. Every night at 9. Only on Movies Now.
Welcome back. We are at Dublin at the IDC Grand Central in Mumbai, and I'm still in conversation with Mr. Sivasubramanian of Franklin Templeton Asset Management. Siva, let's discuss some of your individual funds, starting off with Franklin India Blue Chip, which is the oldest equity fund from a private sector house in India. When I look at your portfolio, again, it's concentrated, so the top 10 stocks have about 45% exposure. What's been the rationale behind keeping that exposure? Because within the top 10 stocks, the outperformance or the alpha has really come in only from the private sector holdings, not from the leaders of the other sectors that you've chosen. So what's been your rationale behind keeping your conviction with the top 10 holdings?
Well, some of the top 10 stocks are stocks like Bharti, which, like I explained earlier, have not done too well in the past 2 years or so. We think that there is a tremendous upside potential in a stock like Bharti going forward. So, if you look at the top 10 portfolios, apart from the private banks, some of the other stocks have underperformed, and we think that, going forward, part of this underperformance will be made up going forward, which is why, you see some of those stocks in the top 10.
So stocks such as Reliance Industries, Infosys, you spoke about Bharti. What is your conviction in these stocks? Is it really the fact that you expect a turnaround in the cycle, turnaround in earnings? Or do you believe that they can help in mitigating the downside risk that may come to the portfolio in a volatile market?
Clearly, I think a stock like Reliance is a very large weight in the index. We are relatively underweight compared to the index as far as Reliance is concerned. We think that the current price probably reflects all the bad news which is there, and the stock probably will act as a defensive going forward. As far as Infosys is concerned, it's something which we've held in the portfolio for a long period of time. Yes, there have been periods of time when the stock has not done too well. We are still positive on the prospects of the company going forward, and we think that we'll hold on to this.
Is that a broad call across IT?
It's not a broad call. It's a specific call vis-a-vis Infosys. Again, relative to the benchmark, we are underweight in the sector as well as the stock. But we think, given the long-term performance of Infosys and the quality of the company, we think this is a short-term aberration, and the company should start doing well once the problems are sorted out in the US.
The reason I ask you that is because, from a market perspective, post the earnings, there was a lot of focus coming in on TCS and HCL Tech as the preferred trades in IT. You have not changed your view?
We have not changed our view.
Okay. Private banks versus public sector banks. There is one camp that believes that public sector banks can be looked at purely on the basis of value right now. The other believes that, private sector banks are cleaner in their balance sheet, the growth potential is there. So what if they're coming at a higher price? That scarcity premium can be allocated. What's your view?
We obviously belong to the second camp. We think that the performance of the private banks have been far superior in recent times related to the PSU banks, and most of the private banks seem to be well capitalized, and that will help them to capitalize on the growth opportunity in India. PSU banks, on the other hand, while they do appear cheap, in terms of capital adequacy ratios, I think the government has to infuse capital in them for them to grow going forward. And that at this point in time doesn't look like a distinct possibility given the government's position. Apart from that, we prefer banks which are a play on the retail segment, and private banks are a better play on the retail segment vis-a-vis the PSU banks.
Engineering as a sector, as part of this fund itself, you were overweight on the sector in 2009-2010. How do you view the prospects of the engineering space? Again, two camps out there as well. One believes that they've been oversold and the cycle will turn, and that's why these stocks look attractive at these valuations. And one, of course, believes that, things will take their time and these companies need to still get their act together.
What we focus on when we look at a company is to see whether the return ratios justify investing in these companies. And if you look at the sector, there are not too many companies which earn more than the cost of capital over the long run in the sector. There are companies like Cummins, for example, which have done that in the past and have consistently done that, which is why, if you look at our portfolios, we have stocks like Cummins and not the other stocks.
The next fund is Franklin Prima. Now, in this fund, I've seen that without increasing the risk of the overall portfolio, you've been able to generate above average returns. How have you managed to do that?
Well, I think alpha really comes in focusing on good quality companies which can deliver above average return on equity over the long run. And we tried to sort of focus on good quality companies in the mid-cap space. There would be periods of time when these companies underperform the broad market, but in the long run we've seen that focusing on quality of the companies and focusing on return ratios stands us in good stead, and it has helped us definitely as far as the Prima fund is concerned.
What are broad benchmarks that you follow to certain risks for a company and not make them part of your portfolio, or conversely add a company based on attractive valuations?
Well, there are many metrics, when you look at valuation, there's no simple benchmark which we can spell out. But in terms of what kind of companies we look at, definitely we look at businesses which have long-term growth potential, businesses which can protect margins both in a down cycle and earn superior margins in an up cycle, and also we definitely focus on the quality